This is Chapter 3, Accounting Basics. In this chapter, you will learn important roles of the chart of accounts, the relationship between items and the chart of accounts, accounting methods, and double entry accounting. Now, if you were with me through the bookkeeping course last week, a lot of this will sound familiar to you. The chart of accounts is the backbone of accounting software systems like QuickBooks. In order to record transactions such as sales and expenses, the chart of accounts must be properly set up. In QuickBooks, another term used to describe the chart of accounts is categories. In the Setting Up a New Company File chapter, we will walk through the basic setup of a new QuickBooks Online account. During that setup, we will indicate the industry our fictitious business, Luxury Lodging Incorporated, falls into. QuickBooks uses this information to create a generic chart of accounts list so that you don't have to start from scratch. One of the benefits of using QuickBooks is you can add new accounts to customize the chart of accounts for your business. When adding new accounts, you will need to select an account type. There are 5 account types that make up the chart of accounts. We have assets, liabilities, owner's equity, income, and expenses. So assets, these are items that your business owns. The cash in your business checking account, your computer, and also all of your inventory that you have on hand. These are all examples of assets. Next are liabilities. Money owed to creditors or suppliers are liabilities. So assets, anything the company owns. Liabilities, anything the company owes. So a line of credit with a financial institution or an accounts payable balance are all examples of liabilities. Next, you have your owner's equity. Funds invested in a business by the owner minus owner withdrawals plus net income or minus net loss since the business began. Income, the sale of products and/or services, is considered to be income. For our fictitious business, Luxury Lodging, the sale of lodging is considered income. Then we have expenses. Money spent to maintain the daily business operations are expenses. For example, payments made for rent, utilities, and insurance are all examples. Assets, liabilities, and owner's equity are included on the balance sheet report. Income and expenses are included on the income statement, also known as the profit and loss report, or P&L. You will learn more about these reports in the Creating Financial Reports chapter in our book. QuickBooks is ideal for people who don't have any type of accounting or bookkeeping background. There's no need to know debits and credits when using QuickBooks. I'm sure those of you with me last week will be happy to know that QuickBooks takes care of all of that for you. We went through the bookkeeping courses, like I mentioned last week, to get some background information so we understand what's going on in the background of QuickBooks. What is it doing? How is it, getting these figures for us? But technically, QuickBooks takes care of all of that for us. So the relationship between the chart of accounts and the items list makes this possible, and we'll take a look at this next. So the items list is a list of the products and services that a business sells. In the Managing the Products and Services chapter, we will cover how to add, edit, and delete items. Now, in order to get to your item list, if you go down to All Apps, and let me see, if you hover over Inventory, your item list let me see. So your item list in QuickBooks Online is actually called the Products and Services list. So you can go to it that way by selecting Inventory, or you can also click on your gear icon and here in the list section, products and services. Okay, so we will get into how to add items to our list, but I just wanted to show you how to navigate to that for now. This chapter is mostly just going through some background, terms and methods, but we'll get into navigating and also adding accounts into our chart of accounts and items into our products and services, aka our items list. So in the Managing the Products and Services chapter, we will cover how to add, edit, and delete items. When adding a new item to the items list, one of the requirements is that you link the item to an account on the chart of accounts list. The account field is a required field, which means you are not able to add a new item without selecting an account. The reason for this is when you use an item on a transaction, such as an invoice, QuickBooks will automatically record the debits and credits behind the scenes based on the account that is linked to the item. So for example, they show their products and services information screenshot there. They are adding an item to the items and service to the products and services list, which is a 1-bedroom and loft, and that is linked, you can see in the bottom right hand corner, to the sales income account. So the income account field shown in the image above shows the sales account. This means that each time that a 1-bedroom plus loft is sold to a client, QuickBooks will record the sale to the sales income account. Depending on whether the sale is a deposit received prior to the client's stay or a payment upon arrival, will determine the offsetting account. At any rate, you do not have to know which accounts to debit or credit. Again, QuickBooks takes care of that for you. All right, then you have two types of accounting methods. These are known as cash basis and accrual basis accounting. The accounting basis you choose determines when revenue and expenses are recognized. A business that uses the cash basis accounting method recognizes revenue and expenses at the time that cash is exchanged. And it doesn't mean cash in the literal sense, because payment can also be made, by check, credit card, things of that nature. But the bottom line is cash basis means payment is made or received at the time that services are rendered or products have been shipped or received. On the other hand, a business that uses the accrual basis method of accounting recognizes revenue and expenses as soon as services have been rendered or products have been shipped. For example, let's say a consultant provides a couple of hours of services to a client and leaves them with a bill or invoice to pay at a later date. If this consultant is on the accrual basis of accounting, the sale of services counts as revenue immediately. It does not matter when the customer actually pays the invoice. Most small businesses start out using the cash basis method. However, there are some restrictions to the type of businesses that can use this method. According to the IRS, the following types of businesses should not use cash basis accounting: businesses that carry an inventory, C corporations, or businesses with gross annual sales that are over $5 million. One of the benefits of using QuickBooks is you can start recording transactions and decide later on which method to choose. The accounting method that you choose does not affect how transactions are entered. You can run reports and select the method you would like to use, cash or accrual. When you file your very first tax return for a business, you will need to indicate the accounting method you would like to use. Based on that selection, you will run your financial reports using the method chosen. All right, our next section is double entry accounting. Again, this will be familiar to those of you who have already gone through bookkeeping. Double entry accounting means for every transaction recorded, there are at least two sides, at least, can be more, one debit and one credit. This ensures that both sides of the accounting equation remains in balance. Remember, our accounting equation, assets equal liabilities plus owner's equity. So they have an example for us. Let's say Luxury Lodging Inc. received a reservation for a 1-bedroom plus loft for 4 people in Malibu Beach, California. The booking is for 5 nights at a daily rate of $400. In order to secure the reservation, a non-refundable deposit for 1 night is required. In addition to an increase in the business checking account, which is an asset, there would be an increase in the income from lodging account, which is your owner's equity. So you would plug in those numbers, $400 for your assets, no liabilities, $400 from your owner's equity. So you can see both sides of the accounting equation are in balance with $400 on each side. So the behind the scenes of what QuickBooks is doing is what we did in bookkeeping, which is adding that journal entry. So you can see the business checking account increased with a debit of $400. But the income account, the income from lodging, which was your owner's equity, was increased with a $400 credit. So that is in balance. So the business checking account is increased with a debit by $400, and the income from lodging account is increased with a credit of $400. To record this transaction in QuickBooks, you would simply record a sales receipt that shows the 1-bedroom plus loft item listed. And when you save the transaction, QuickBooks creates that journal entry in the background for you. You don't even see the journal entry when you create the sales receipt. Nothing even comes up on screen about journal entries or anything like that. It's all done in the background of QuickBooks. All right, so our next video will actually start, doing some steps and creating some things. Will be Chapter 4, setting up a new company file.